Every time you tap your card, part of your purchase goes to your bank. You do not see it on a receipt. Stores pay a fee to accept cards, and prices rise to cover it. That is one way banks make money from you. In this video, I will show you the rest: interest, fees, and services, and the simple moves that keep more money in your pocket. Banks are businesses. Here is the simple picture. They earn on loans and investments. They collect fees on accounts and payments. They sell services like payments and wealth. I will break each one down in plain English, then give you a checklist to avoid the worst costs. Let's start with interest. Banks earn interest on loans and on some investments. They pay interest on deposits and other funding. The difference is the spread, and for many banks, it is the main engine of revenue. Simple example: a bank might earn around 6% on a mortgage or a small business loan and pay 1 to 2% on many deposits. That gap, after costs and loan losses, becomes income to the bank. But there is one myth to clear up. Banks do not literally lend out your exact deposit. Think of it as a spread business. They aim to earn more on assets than they pay to fund them. That is what you see in bank earnings every quarter. Next, fees. There are two buckets of fees. First one is account and penalty fees, overdraft and non-sufficient funds, monthly maintenance, out-of-network ATM, wires. These charges have fallen in recent years at many banks, but they still add up for customers who are not watching their accounts closely. Second are card and payment fees. When you pay with a card, the store pays a fee, often about 1 to 3% of your purchase, to accept that card. That fee is shared across the payment chain, and a portion goes to the bank that issued your card. This helps fund customer rewards and card operations. But there is also a bottom line. Even if you try to avoid fees, card economics are baked into prices across the economy. Banks also earn non-interest income from services, payments and merchant services, wealth and trust, mortgage servicing, co-brand card deals with airlines or hotels. For some banks, these are steady. For others, they rise and fall with the economy. Together, they make up the other half of revenue next to the interest spread. Here is your checklist on how to avoid fees. 1. Pay credit cards in full. Rewards are not worth it if you carry a balance. 2. Pick accounts with no monthly fee and low ATM costs. 3. Ask your bank for a better savings rate or move to a better one. 4. Use free or low-cost payment rails when you can. And 5. Redeem card rewards but never chase points into debt. So, how does your bank make money from you? 1. A spread between what it earns on loans and investments and what it pays on deposits and funding. That difference is direct income to the bank. 2. Fees on accounts and every card payment at the store. Every time you swipe, someone is paying. And 3. Services like payments, wealth, and partnerships. Your goal is simple. Use the service, avoid the traps. If you want simple, no-nonsense explanations on how money works, subscribe and hit the bell button. Tell me in the comments, which bank fee annoyed you the most and how did you avoid it?